Welcome back to the Daily Gold University. This is lesson number 11, our final lesson in this series. These are my predictions and expectations for the current secular bull market in precious metals and how it will play out over the coming years. This chapter analyzes how the secular bull market in gold and silver will evolve and where and when it could end. The final targets are easier to measure than the timing and evolution, which are impacted by the end of the secular bull market in U.S. stocks and gold yet to break out against the 60-40 portfolio. Side note, it has broken out against the 60-40 portfolio. That happened in March of 2025. Figure 11.1, an updated image from Lesson 7, plots the gold price along with the price required to back the United States monetary base by 40% and 100%. The Federal Reserve Act of 1913 mandated a minimum backing of 40%. The calculation is derived from the current gold price multiplied by U.S. gold reserves and then measured against the monetary base. Around the time of secular peaks in gold in 1980 and during the Great Depression, 1940 to 1943 specifically, backing was over 100%. From the end of 1979 through 1980, backing exceeded 100% for 13 consecutive months and reached as high as 139%. From 1940 to 1943, backing reached as high as 163%. Currently, 100% gold backing of the monetary base requires a gold price of roughly $21,300, while 40% gold backing requires a gold price of roughly $8,500 an ounce. The highest backing in recent decades was 29.7% in early 2008. That would equate to a gold price of roughly $6,300 an ounce. Until 1990, gold backing was at or above 40% throughout history, except for the late 1960s. Circling back, we see that the gold price at both historic secular peaks, 1934, 1942, and 1980, achieved over 100% backing. Therefore, a reasonable target is the 100% backing price of $21,300 an ounce. However, that price is based on today's snapshot. Consider how much higher the 100% backing price moved after the 2008 global financial crisis and COVID-19 in 2020. Even one moderate recession could push that figure to $30,000 an ounce. Next is another look at gold against the S&P 500 in figure 11.2. There have been three major peaks in the past 130 years. The gold to S&P 500 ratio peaked at 6.2 times in 1980 and 4.6 times in 1934. Before that, it peaked at 5.4 times in 1896. The peak in 2011 was at 1.50x. Considering history, a target of 4x or 4 times is reasonable. One could think that the ratio at 0.45x is historically low and will not be able to rise 9x from here. However, the ratio was at an all-time low in the late 1960s and rose 16-fold. Using daily closing prices, it rose 20 times to nearly 7.5 times. The current S&P 500 of 6,000 multiplied by a ratio of 4x equates to a gold price target of $24,000 an ounce. An S&P 500 of 6,500 multiplied by a ratio of 4.5 times equates to a gold price of nearly $30,000 an ounce. Let's consider silver's upside potential in this secular bull market. After assessing gold, we can evaluate silver's upside potential using the gold to silver ratio as shown in figure 11.3. At the two most significant inflationary peaks of the 20th century, 1920 and 1980, the ratio bottomed at 16x and 18x, 16 times and 18 times. It declined to as low as 14 times in 1968, but was artificially low due to the gold standard in the fixed price of gold. The low at silver's 2011 peak was 32 times, 32x. For most of the past 40 years, the ratio has ranged from 45x to 90x. This sounds ridiculous, but given that silver is trading around $30 an ounce, this sounds ridiculous given that silver is trading near $30, but silver could reach $1,000 an ounce in the secular bull market. We have shown the potential for gold to reach $20,000 to $30,000 an ounce. For silver to reach $1,000 an ounce, a gold to silver ratio of 20 times to 30 times is required. A ratio of 20 times and a gold price of $25,000 an ounce equates to a silver price of $1,250 an ounce. Moving on, let's take a look at the potential time frame for the secular peak. First, we consider the time between past secular peaks in precious metals, peaks in the stock market, and bottoms in the gold to 60/40 portfolio ratio. Note figure 11.4. The last two secular bull markets in precious metals ended 11 years after the stock market's secular peaks. The S&P 500 has not reached a secular peak, but it's possible in 2025 or 2026. That would push the secular peak to the early second half of the 2030s. Gold against the 60/40 portfolio began moving toward important breakouts some 9 and 10 years before the secular peak in precious metals. We are in 2025 and have yet to see that breakout signal. Side note, we are in 2025 and now we have seen that breakout signal. Again, it happened in March of 2025. The status of the S&P 500 and gold to 60/40 portfolio ratio suggests a potential secular peak in the mid-2030s, but there is a prominent cycle that argues for an even later peak. I do not like most cycle analyses because cycles are subjective, but there is a strong track record in the following. There is a very long-term cycle of inflation and commodity price peaks because of the alternation between secular bull markets in U.S. stocks and commodities and the long-term cyclicality of commodity prices. Figure 11.5 from Barry Bannister, Managing Director and Chief Equity Strategist at Stifel, shows the rolling 10-year analyzed return in commodity prices. The peaks over the last century have been roughly 30 years apart, with major peaks every 55 to 60 years. Figure 11.6, courtesy of Thunderset Energy, shows an equal-weighted basket of commodity prices dating back over 200 years. Again, note the peaks are 30 years apart. I added the dates in figure 11.6. As an aside, commodity prices exploding higher after 1971 was a breakout from over a 100-year-long base and the greatest breakout of all time. That includes gold. The prevalence of a 30-year cycle in commodity prices and inflation also necessitates a 60-year cycle, which carries more significance. Since the inflation of the Civil War, the 10-year Treasury yield has made only two yield peaks, 1920 and 1981. As an aside, the 10-year Treasury yield surpassed its 1920 peak in the late 1960s, leading to the end of the secular bull market in U.S. stocks. Also, the 1920 and 1980 peaks in commodity prices held for quite a bit longer than the peaks in 1951 and 2011. In short, history shows that there could be an extremely significant inflationary peak at the end of the next decade, being the 2030s. Considering the above analysis, the secular bull market in precious metals could evolve in one of two ways. If the secular peak is to occur around the middle of the 2030s, then the template is a repeat of the previous two secular bull markets. This entails two major legs higher with a major downturn or crash in the middle. The other scenario is that the secular bull market will not peak until the end of the 2030s. That would entail three major legs higher and two cyclical downturns, similar to the secular bull market in gold stocks from 1960 to 1980. There will be no hint about timing until we confirm that the secular bull market in the S&P 500 has ended and that gold has clearly and convincingly broken out against the 60/40 portfolio. With respect to the next few years, whether gold has broken out against the 60/40 portfolio or not will inform us about the potential upside in both metals. Side note, gold has broken out against the 60/40, but we have yet to see confirmation that the secular bull market in U.S. stocks has ended. In figure 11.7, we plot the four best cyclical advances in gold on the scale of the current advance, which began in the fourth quarter of 2023. We mark the start of the advances, not necessarily from a price low, but from where gold began an impulsive and unimpeded advance. Gold is closely tracking the average of the four best advances, which reaches $5,000 an ounce by the end of summer 2026. For this chart to remain viable, gold must break out convincingly against the 60/40 portfolio at some point in 2025. Side note, again, this has happened. If that breakout proves the chart viable, given that gold is in blue sky territory and just broke out of a 13-year cup and handle pattern, we should expect the advance to be stronger than the average. The two advances in the 1970s reached roughly $14,000 an ounce and $9,000 an ounce in 2027 on the current scale. Those targets are excessive, as one was the final blow-off move and the other began at an artificially low price at the beginning of the 1970s. Nevertheless, a target of $7,000 to $8,000 an ounce in 2027 to 2028 is not unreasonable. Keep in mind that the four best cyclical advances were followed by a 45% decline, 1975 to 1976, two secular bear markets, and a 30% decline in 2008. The more spectacular the move to the upside, the more likely a cyclical bear market will follow, entailing a 30% to 40% correction in the price of gold. Figure 11.8 plots gold's performance following a sustained breakout to new all-time highs. There were four breakouts to new all-time highs, but we exclude 2007 breakout, which was soon reversed during the global financial crisis in 2008. We plot on the scale of the March 2024 breakout through $2,100 an ounce. The dotted lines show an average of the three breakout moves and an average of the two longest-lasting breakout moves. For this chart to remain viable and for gold to retain the momentum that emanates from a breakout to new all-time highs, gold must break out against a 60-40 portfolio in the first half of 2025. Side note, again, that happened. Gold has spent most of its breakout time below the averages. We can use the same analog charts to evaluate silver. In figure 11.9, we plot the four best cyclical advances in silver, which, in terms of the calendar, align very closely with the advances in gold. We plot on the scale of the current advance, which began in February 2024. The dotted line is the average of the four advances. Interestingly, the advances coalesce and hover around $50 an ounce for more than a few months. The average begins its move to $50 an ounce at the very end of 2025 and then breaks above $50 an ounce at the end of the first quarter of 2026. The analysis of the long-term technical outlook for silver is simpler than gold at this juncture, as silver has yet to break out past its massive base and resistance at $50 an ounce. Upon a break past $50 an ounce, silver has a measured move of $96 an ounce. In other words, a clean break above $50 an ounce should lead to $100 an ounce for silver. We can evaluate a cyclical target for silver using the gold target and the gold to silver ratio. If the gold target is $7,000 to $8,000 an ounce and the gold to silver ratio is 50 to 60, we have a target for silver above $100 an ounce with a maximum of around $150 an ounce. Note the gold to silver ratio chart earlier in figure 11.3. Finally, it is important to note that precious metals will be negatively correlated to the stock market over a chunk, but not all, of the next 10 to 15 years. This occurs more so in inflationary periods, but also around the time when the gold to 60-40 portfolio confirms a secular trend change. Figure 11.10 plots the various markets from 1969 to 1978. The blue line marks when the gold to 60-40 portfolio ratio began its secular breakout move at the end of 1971. The two red lines mark the near 50% bear market in the S&P 500. Note that gold, silver, and the gold stocks made huge moves higher during that time. The negative correlation between the stock market and precious metals continued into 1978. When the stock market and economy recovered in 1975, precious metals suffered and experienced a nasty cyclical bear market until the second half of 1976. Precious metals were also negatively correlated with the stock market at the start of the previous secular bull market, the 2000-2011 one. Figure 11.11 plots the various markets from 1998 to 2003. The two red lines mark the extent of the bear market in the S&P 500 from March 2000 to October 2002. The blue line marks when gold began its secular confirmation move against the 60-40 portfolio, late 2001. Gold stocks bottomed first, soon after the S&P 500's failed retests of the March high or double top at the end of summer 2000. Gold bottomed in the first quarter of 2001, and silver bottomed at the end of 2001. Recency bias is leading many to think that precious metals cannot rise during a bear market in the S&P 500. After all, the two declined together through most of 2007 to 2008, the COVID-19 crash in 2022. Therefore, they assume precious metals will fall during the next economic and market downturn. However, history shows that when there is a secular turn in the gold to 60-40 portfolio ratio in favor of gold, precious metals will trend higher in the face of a cyclical bear market in stocks. This happened during or around the start of the previous two secular bull markets in gold. The negative correlation occurs at the beginning of a secular trend change for two reasons. First, capital is overinvested in equities and conventional investments and underinvested in gold and precious metals. There is little selling power in precious metals during the forthcoming downturn. Second, for there to be a secular shift in gold's favor, there must be a clear period of negative correlation between precious metals and equities. Without that period, there is no secular shift. Hence, the negative correlation occurs at the beginning of the new secular bull market in precious metals. Chapter summary. A secular peak in gold and silver, and any market, has two parts, price and time. Regarding price, the first three charts of this chapter support targets of $20,000 an ounce for gold and $1,000 an ounce for silver, targets of $30,000 an ounce for gold, and even $1,500 an ounce for silver are not unreasonable. Remember that prices would spend little time in the upper half to upper third of these targets. They will reach those levels, but not stay there. Concerning timing, the secular peak could come from the mid-2030s to the decade's end. Considering the timing of the secular peak in the stock market and gold breaking out against the 60-40 portfolio, the peak could be closer to the middle of the next decade. Secular peaks in inflation and commodity prices have occurred roughly every 30 years, with historic inflationary and interest rate peaks occurring every 60 years. Both support a secular peak of around 2040. Precious metals are poised to benefit from the next economic and stock market downturn, which will occur when gold breaks out against the 60-40 portfolio, signaling a turn in the secular trend. Side note, that's happened. For part of the next 10 to 15 years, there will be some negative correlation between precious metals and the stock market cyclically. That brings us to the end of lesson number 11 and the end of this Daily Gold University series. We will have a bonus lesson coming up, and after the bonus lesson, we will produce another series as part of the Daily Gold University. It will focus on technical analysis of precious metals. Thank you so much for tuning in to this lesson and all of our lessons. We hope you enjoyed them all and learned a lot. I'll see you guys in the bonus lesson. Thank you.